Welcome to this presentation on full spectrum flood hazard and pricing flood risk. I'm Bob Jacobson, a professional engineer and consulting hydrologist from Baton Rouge, Louisiana. More information on my background and experience is provided at the end of this presentation. This presentation is an outgrowth of one I've been giving over the past 2 years since the catastrophic flood in Baton Rouge in August of 2016. So far, I've given portions to more than a dozen organizations and received some good feedback. After you've watched it, please share your thoughts with me. If you determine that attending this online presentation counts toward your continuing professional development, you can print the last slide and fill it out to document your attendance. Let's start with a very old proverb about wise and foolish builders. A wise man built his house on the rock. The rain came down, the streams rose, and the winds blew and beat against that house. Yet it did not fall because it had its foundations on the rock. A foolish man built his house on sand. The rain came down, the streams rose, and the winds blew and beat against that house, and it fell with a great crash. This proverb is about 2,000 years old. Any guesses as to who said it? It comes from the end of Jesus' Sermon on the Mount, when he uses it as an analogy for the keys to creating a lasting community. In the news, along with debate over the various causes, I'm going to be describing a burgeoning revolution in the way flood risk is approached. This presentation addresses the three key challenges of getting everyone to understand, professionals to use, and political leaders to support the state-of-the-art and wise framework for flood risk management, which we call full spectrum flood hazard and pricing flood risk. We'll begin with part one, educational challenges. Some of the basics may be old hat to the more knowledgeable of you, but I've included them to make sure we're all on the same page. First, a quick reminder. Flood hazard should be considered specific to each individual property. Because of obstructions in the floodplain, the flood elevation can be very different for one property versus another nearby. Similarly, changes in topography over short distances can drastically affect flood depth. There are two foolish approaches to flood risk that have been around for a long time. The first foolish approach is making judgments about flood risk from your or your family's and neighbors' personal history. After every big flood, we always see someone on the TV news saying, "There's never been that much water here before." The problem is personal or even family history is way too short a time span to assess the magnitude of rare floods. Instead, you need the perspective of many thousands of years. The second foolish approach is the idea that you can draw a line on a map and say that on this side there's risk and on the other side there's no risk. We call this a false binary. This binary approach is false because in truth there are always shades of flood risk as well as uncertainty. So there really is no such thing as a or the flood zone. When we think of a risk as binary, we're usually tempted to push right up to the edge. Both foolish approaches also ignore one other important thing. The magnitude of rare floods are often changing because of both long-term trends and cycles in critical conditions. Important changes include rainfall and hurricane climate, the sea level, rivers and floodplains, and land use and cover. One alternative to a binary framework is to use several categories or scores. An obvious example is the Saffir-Simpson scale for hurricane winds. Having several categories is more granular, so that's better than a simple risk versus no risk. But categories don't provide a true quantification of flood hazard, which we really need in order to make good decisions. We'd be much better off if we could numerate the odds for getting 2 inches of flood depth in our home versus say 1, 2, or 4 feet, the way that we can numerate the odds of drawing 1, 2, 3, or 4 aces out of a deck of cards. The way to enumerate flood hazard is with the concept of return period. Return period is the average recurrence interval, or how often for rare floods a level is reached over many thousands of years. To determine the return period, we just divide the length of the flood record by the number of times the level has been reached. So, if a particular flood level was reached 10 times in 5,000 years, that's an average return period of 500 years. Let's make sure we're emphasizing the word average, because we're not saying that there are exactly 500 years between each occurrence. Once we know the average return period for a particular flood level, it's easy to figure out the odds or chance of that flood level. We call this the annual exceedance probability, and it's simply equal to 1 divided by the return period. This is the probability of that flood level being reached in any calendar year, for each and every individual calendar year. A 500-year return period flood has an AEP of 1 over 500, or 0.002 in decimal form, or 0.2%. When we fill in a graph line showing flood elevation versus return period, we have a full spectrum of the flood hazard. Starting in the lower left and moving to the upper right, the S-shaped graph line shows the higher flood level, which corresponds to any longer return period or to any lower annual chance. We use a logarithmic horizontal scale so we can more easily see how the hazard changes over a wide range spanning several orders of magnitude. In this example, flood hazard is pretty flat at 22 to 23 feet up to about the 5-year return period, hits 25 feet at the 10-year return period, then rises steeply to 48 feet for the 100-year return period, and finally begins to flatten out as it reaches 58 feet for the 1,000-year return period. For a fairly reliable flood return period, you need a flood record for that location at least 5 times as long, better if it's 10 times. There are very few continuous reliable gauge records spanning more than 100 years. So those gauge records only provide decent values up to about a 20-year flood level. When gauge records are not long enough to define flood levels for larger return periods, hydrologists have to employ additional statistical techniques. And if they don't have a local gauge, hydrologists have to, in essence, create a synthetic record by simulating what goes on during a flood for a wide range of potential storms. Both of these methods involve elaborate techniques for estimating flood hazard, and they have uncertainty. Often the uncertainty, or what we call confidence interval, is pretty large. So we need to be clear. While hydrologists use very rigorous scientific and statistical techniques, it is often better to think of a flood hazard developed with these methods as scientific guesstimates. The idea of depicting flood hazard with a graph of the full spectrum is not new. Hydrologists started using full spectrum flood hazard routinely back in the 1950s as part of the design of major reservoirs, dams, and levees. This is an example of 3 full spectrum graph lines created for 3 locations around New Orleans by the Corps of Engineers in 1966. In this example, the Corps did not illustrate the uncertainty with the graph lines. Coastal gauges are some of the oldest in the U.S. For many coastal gauges, NOAA provides full spectrum graphs and the uncertainty. This example illustrates the large uncertainty in the estimates of the full spectrum flood level for a coastal gauge with 6 decades of data. If you flip the uncertainty around to look at it in terms of the return period, you see that the estimate of the 100-year flood is within the confidence interval for a 50-year flood. NOAA has also long provided full spectrum with uncertainty for rainfall. A NOAA website now provides the full spectrum of rainfall accumulation in inches for any duration event for any location in the U.S. online. This is an example for the Baton Rouge area for the 24-hour duration rainfall event. Note how the vertical uncertainty band for the 100-year return spans from about 10 to 15 inches. Looking at uncertainty in terms of the horizontal scale, the return period uncertainty band is extremely large. Let's pause a minute and really acknowledge this large uncertainty band with even the best hydrological hazard estimates. In this case, we're talking just about rainfall and estimates based on well over a century of data across the whole Gulf Coast region using extensive climatological and statistical analysis. But, and this is critical, let's also appreciate that this large uncertainty band does not mean the full spectrum estimates are not useful. State-of-the-art full spectrum information with defined uncertainty is in fact crucial to many economic decisions that involve a range in tides or rainfall over a long period of time. Unfortunately, however, full spectrum information with uncertainty is not currently the norm in flood economic decisions. To get flood hazard information for a piece of property, most folks use a flood insurance rate map, or FIRM. Here are 6 key points to understand about FIRMs. First, most FIRMs are funded by FEMA under the National Flood Insurance Program, and thus FIRMs are limited by the scope of and funding from the NFIP. Second, the NFIP flood risk framework is still rooted in an approach that was developed at its inception by Congress in 1968. The FIRM emphasizes one zone or level, the 100-year flood. The NFI framework is thus a false binary. FIRMs don't provide full spectrum flood hazard. Now, 50 years later, that approach is antiquated. Third, most FIRMs have been prepared with synthetic floods because there are no nearby long-term gauge records. Fourth, most NFIP studies of synthetic floods have used decades-old technology, including obsolete methods for the range of storm scenarios, the hydrology, simulating where and at what rate rainfall runoff occurs from any storm, the flood flow hydraulics, modeling how the collected runoff water, or incoming surge in the case of a hurricane, gets routed around and inundates the surrounding floodplain, and changing climate, sea level, subsidence, rivers, floodplains, and land use. Fifth, FIRMs don't provide any indication of the uncertainty in the 100-year flood zone. And because FIRMs have additional uncertainty associated with modeling a synthetic record, their uncertainty is often greater than the uncertainty for return period rainfall or gauge records. Finally, sixth, the process under which FIRMs are developed and over time modified is subject to a lot of one-sided pressure to shrink the 100-year flood zone and lower the 100-year flood level. There is usually very little lobbying for expanding the 100-year zone for a factor of safety. Let's consider an example. Let's say Mr. Emoji is going to build a new home. Mr. Emoji looks up his local flood insurance rate map, which anyone can now easily do online, and sees that the 100-year flood zone near his property is at an elevation of 44 feet. Mr. Emoji is like most people right now and takes the FIRM as gospel and just goes along with the binary idea about flood risk. And this leads to Mr. Emoji and his community making a series of foolish decisions about how high to build his home, about how subdivisions and other buildings ought to be developed, about how drainage and flood control projects should be designed, and very foolishly about whether to even carry flood insurance. But, as I just described, firms are very often wrong, and they don't convey all the levels of flood hazard, and they don't provide the full spectrum flood hazard graph for Mr. Emoji's property. And of course, they don't show the large uncertainty. In this case, Mr. Emoji thought he was building his new home above the 100-year flood zone, but in fact, he is well below the 100-year flood level, and he is actually exposed to a severe flood damage, 5 feet, from a storm just slightly less likely, the 150-year flood. We need to appreciate a couple more critical things about flood hazard. First, most of us that own property are in fact exposed to flood hazard for a long time. Mortgage durations might be 30 years, community planning might have a 50-year time horizon, and a typical lifetime might be 80 years. Over longer durations, we are in effect taking that annual chance, that AEP, not once, but retaking it 30, 50, or 80 times. And this means that the probability for the various flood levels can go up tremendously. Here are some examples for just the 30-year period. Let's play an imaginary game of chance. Imagine that when you go to a mortgage loan closing, you're handed a pair of dice to roll once, and the result is sealed in an envelope and opened in 30 years. If you rolled a 5, then you have to write an additional check equal to your total expense for a 250-year flood. If you rolled an 11, a 500-year flood. And if you rolled snake eyes, a 1,000-year flood. Under the current NFIP framework, most property owners do not consider these odds and do not carry insurance to cover them. Yet they do for similar odds when it comes to a house fire. It's beyond foolish. It's crazy. This figure shows the probabilities for a 30 and 80-year exposure for the return periods and AEPs presented on the horizontal scale in the previous graphs. So, for example, that new home that Mr. Emoji thought was safe because it was above the firm 100-year zone, but really faces serious damage from a 150-year flood? Well, over a 30-year mortgage, his chance for that event is almost 1 in 5. The second additional thing we need to appreciate about flood hazard is the idea of multiple independent exposures. Independent exposures, or chances, are like rolling more than one pair of dice at the same time. 3 examples of independent flood exposure are exposure to more than one type of flood, flash, riverine, backwater, and coastal, exposure to flooding from 2 or more independent directions, and locations that are far enough apart and essentially not subject to the same event. So suppose you oversee regional planning for a large basin, and let's say the area includes 5 independent flood exposures. The chance of a 1,000-year flood occurring somewhere in your basin over a 50-year period is 22%. Up until now, I've been speaking primarily about flood hazard, the probability of water getting to a certain elevation or depth at a location. Let's define flood risk, which is based on 3 things. First, it's based on the full spectrum flood hazard at that location, taking into account also the probability for failure of any drainage or flood control measures, such as a plugged up drainage canal, a broken pump station, or a levee failure. Second, risk factors in the various consequences associated with each flood level on the full spectrum graph. And third, risk integrates those consequences over a meaningful time frame and meaningful exposure sources and locations. A key here is that the various direct and indirect economic consequences can be priced. So this means that we can actually price the full spectrum flood economic risk for any location, private or public. Let's go back to our example and price Mr. Emoji's private flood economic risk. This green curve covers all of Mr. Emoji's flood-related damages to his house and contents and additional expenses such as for temporary relocation and lost income. There is little to no total loss until about the 80-year flood, and then the damages ramp up to over $300,000. In this example, that 150-year return period flood, the one with the potential 5 feet of flood depth, has an economic loss of $200,000. And again, that's an almost 1 in 5 chance over a 30-year mortgage. A good thing about this green full spectrum economic risk curve is that we can integrate it into a single number, the average annual cost. In this example, Mr. Emoji's average annual cost is about $2,000. We can also use the math of integration to incorporate many uncertainties surrounding Mr. Emoji's risk curve. This provides what is known as the expected annual cost. In this case, it increases to about $2,100. This yellow graph line shows the cumulative cost over a period of 30 years for the expected annual cost of $2,100. Over 30 years, that cumulative total is $63,000. We can further factor in the anticipated future increases in expected annual costs for changes such as changes in climate, sea level, subsidence, river and floodplain, and landscape. In this case, the green curve shows a 1% per year increase in the expected annual cost. This increases the cumulative total to $73,000. And we can factor in inflation over 30 years. The blue curve shows the effect of a 4% rate of inflation, which raises the cumulative total to over $122,000. It is now a straightforward calculation to figure out the lump sum dollar amount we would have to set aside today to cover the 30-year future outlay in the blue curve. At an interest rate of 5%, that present value is over $54,000. This means Mr. Emoji's house is worth substantially less than an equivalent property with very negligible flood risk. Hopefully, this little exercise shows just how important pricing flood risk is. There are 8 points to highlight about pricing flood risk. 1. As indicated in the previous slides, pricing flood risk is the sound, robust, quantitative approach to characterizing location-specific flood economic risk. And pricing flood risk involves 5 steps. Step 1 is to prepare a full-spectrum flood hazard curve, and this step is typically the most time-consuming and expensive step. Step 2 is to produce the full-spectrum flood economic risk curve using the total losses at each depth based on depth damage correlations. Step 3 is to integrate the curve, incorporating appropriate uncertainties to get the expected annual cost. Step 4 is to then factor in future increases in the hazard curve from changes to climate, sea level, subsidence, rivers and floodplains, and landscape, as well as inflation. And finally, step 5 is to convert the expected annual cost over the future time span to a present value. 2. There is significant remaining unintegrated uncertainty in the estimate of a location-specific expected annual cost and present value. These remaining uncertainties can easily be greater than plus or minus 30%. 3. Despite significant remaining uncertainty, as long as the estimates are unbiased, location-specific expected annual cost and present value are very good for making economic comparisons, such as comparing the flood risk for different homes one might be interested in purchasing. 4. The expected annual cost and present value for individual locations can easily be aggregated over whole neighborhoods, watersheds, and regions. 5. The integration step, combined with aerial aggregation, can average out many location-specific random uncertainties, such as with true ground elevation and depth damage correlations. This actually reduces the uncertainty with regional aggregate estimates. 6. Pricing risk has a very long, well-established history of being used in managing economic risks for fire, wind, drought, hard freeze, and other hazards. 7. Pricing risk is essentially the basis for what is known as actuarial cost in the insurance industry and is used to efficiently and fairly price insurance policies. And finally, 8. In insurance, when risk is further aggregated over many independent regions and exposures, this even further reduces uncertainty with total overall risk. Pricing flood risk is the wise way to inform and optimize two broad types of flood economic decisions. In big commercial and investment transactions, there is a very rigorous formal process for pricing various risks, referred to as due diligence. In almost all transactions involving property, flood risk is a crucial part of due diligence. Private individuals and businesses, commercial and investment banks, the insurance industry, and government all have a role in due diligence and an opportunity to improve the due diligence process by using pricing flood risk. Private individuals, businesses, and government also have an opportunity to improve ongoing risk management by using pricing flood risk. As you can probably guess, pricing risk has long been the approach to due diligence and ongoing management for fire risk. Well, if we all now are educated on the importance of using full spectrum flood hazard and pricing flood risk, this begs the question, when will full spectrum flood hazard and pricing flood risk be available for all properties? So now it's on to part 2, technical challenges. Like full spectrum flood hazard, pricing flood risk is not new. This is the cover of a Corps of Engineers manual from 1974 that describes how it's done, in theory. However, in the past, professionals lacked the tools. They lacked high-fidelity geographic data sets with 1 meter resolution for topography, bathymetry, land cover, and break lines. Break lines define channel center lines, bank lines, crest lines for embankments, and the divides between watersheds. They lacked sub-acre resolution, two-dimensional models for storms, hydrology, and hydraulics. They lacked extensive data from actual storms to tune model accuracy. They lacked a full range of naturalistic flash, river, backwater, and coastal floods for a long synthetic record. They lacked detailed depth damage correlations for a range of residential, commercial, industrial, governmental, and other structures and facilities, as well as public and private infrastructure. And they lacked advanced computer resources and data processing capable of hundreds of simulations, each with trillions of floating point operations. Over the last decade, there has been a rapid acceleration in the technology to address these issues, including some things we are all routinely using in other spatial and mapping-related applications. Advances in the state-of-the-art include big data processing, cloud storage, high-performance computing, models and data management that run on these supercomputers, and statistical software that can analyze the influence of many factors on the probability of a flood based on the results of hundreds of scenarios. The tools used to prepare the state of Louisiana's Coastal Protection and Restoration Master Plan have been a good example of this dramatic evolution. Increasingly, it is grassroots efforts that are pushing the state-of-the-art in pricing flood risk. As in any free competitive market, advances are being stimulated by demand from customers willing and able to pay for better flood risk management. As the state-of-the-art advances, it stimulates interest from more and more customers and more service providers. As the state-of-the-art progresses, we're approaching the time when full spectrum flood hazard and pricing flood risk will be available for any individual property and any aggregation of properties. When critical change forecasts can be priced, such as for climate cycles and trends, for rainfall and hurricanes, sea level rise, subsidence, river erosion and sedimentation, and landscape change. And when future alternatives, called what-if conditions, can be priced, such as the benefits of flood mitigation measures and the adverse impact of new development and infrastructure. This means that it is only a matter of time before there will be a cell phone app where a home buyer can find the full spectrum flood hazard and average annual cost or present value for a house they are considering. High-end versions of this app will allow a user to adjust inputs for property elevation, key features, depth damages, indirect losses, and assumptions about critical change conditions. State-of-the-art pricing flood risk is already transforming the practice of due diligence that I mentioned earlier. In the future, we can expect more and more commercial and investment loans to have very rigorous evaluations of a borrower's need for flood insurance. This will ultimately lead lenders for home mortgages to also want greater insurance for flood exposure. Insurance for modest flood exposure should be affordable and not an obstacle to transactions, so the pricing of flood risk will expand. However, where risk is higher and insufficiently insured, borrowers will likely be charged higher interest rates. As an example, Moody's Investor Services recently announced that communities with flood risk could see higher interest rates, especially if community-wide participation in flood insurance is low. One last technology point. The state-of-the-art will continue evolving in the future. A key is the synergies between increased use of pricing flood risk, which will prompt demand for better modeling and change forecasts, leading to more accurate pricing, reducing both under and over pricing of flood risk, yielding more optimal due diligence and risk management, and further increasing the use of pricing flood risk. So if according to Part 1 we recognize the need for the transformation toward full spectrum flood hazard and pricing flood risk, and according to Part 2 we're on the cusp of technologically achieving this transformation, then this now brings us to Part 3, political challenges. With every new flood disaster, there are reports in both local and national media acknowledging the fundamental flaws with the NFIP and firms, including all the bad policy decisions that have ensued because of the false binary and the way flood damages are actually exacerbated by the NFIP. The NFIP even overcharges many at moderate risk to subsidize greater risk-taking by others, which perversely discourages many at moderate risk from buying flood insurance. It should be obvious that we need to abandon the obsolete NFIP framework and firms. There are some who want to prevent the revolution towards full spectrum flood hazard and pricing flood risk. But this revolution, like the cell phone app, is coming fast, regardless of government policy, and it would be far smarter for government to help smooth the transition. Here are 5 wise general government policies for flood risk. 1. Adopt the framework of full spectrum hazard and pricing flood risk. 2. Incorporate consensus change forecasts for climate, sea level rise, subsidence, rivers, and land use. 3. Broaden participation in flood insurance for unmitigated risk. Ultimately, insurance is the first and most important line of defense against flood economic risk. Community-wide insurance coverage of flood risk is the single most essential element in long-term community resiliency. 4. Promote only sensible mitigation, projects, and programs. 5. Address equity issues by subsidizing flood insurance and mitigation where appropriate, but Don't overtax flood insurance for those at modest risk. Pricing flood risks makes it clear that sensible mitigation is really flood insurance cost reduction. Just like mitigating fire risk with upgrades to water systems, hydrants, and stations, upgrading flood mitigation has to be worthwhile in terms of the insurance savings to the local taxpayers. If the local property owners don't want to pay the cost of the flood mitigation themselves, then with few exceptions, you'd conclude that they think that kind of money should be used for something else. To further these 5 policies, there are 4 priorities each for local, state, and federal government. For local and regional government, the 4 priorities are: first, consolidate basin-level responsibility and authority and funding in flood risk agencies with boundaries that follow basin boundaries. Second, lead the community to accept ownership of local flood risk. The idea that the community citizens themselves are individually and collectively accountable for broad insurance participation and cost-effective mitigation. Third, make full spectrum flood hazard and pricing flood risk available for every property ASAP. In other words, get the cell phone app up and running. And fourth, use pricing flood risk plus equity factors to drive wise building codes, land use planning, and sensible mitigation, incorporating consensus change forecasts. For state government, the 4 priorities are: first, regulate the flood insurance market fairly and effectively and promote accurate actuarial costs. Second, leverage its resources and efforts across multiple agencies and programs to improve technology and reduce both under and overpricing of flood risk statewide. Especially ripe areas are GIS information, good H&H model demonstrations, and depth damage algorithms. Third, fully empower, stand up, and stand behind basin agencies. A, to evaluate and permit big development and land use changes, as well as local flood control measures, to prevent regional adverse impacts. B, to assume responsibility for funding and directing sensible regional flood mitigation. And C, to help with upsizing bridges and culverts beyond what the Federal Highway Administration and state transportation departments typically fund. It's important to recognize that their standards for bridges and culverts can have adverse impacts. And fourth, lead on remedying equity issues, especially for historically disadvantaged neighborhoods. Finally, for the federal government, the 4 priorities are: first, substantially scale back the NFIP and privatize flood insurance for most coverage needs. Second, update banking regulations to address appropriate insurance for all loan exposure to flood risk and remove any federal backstops for bank flood losses. Third, streamline FEMA, the Corps, HUD, and other agencies to serve in a support role to basin agencies. Fast-track sensible mitigation based on pricing flood risk. And fourth, expand NOAA, the USGS, and other agency research efforts to advance the state-of-the-art in data, modeling, and especially change forecasts. It's been a pleasure to share this presentation on full spectrum flood hazard and pricing flood risk with you. If you have any questions or feedback, I'd love to hear from you. Just email me at bobjacobsonpe@gmail.com. Also, check out my website for more flood risk information and some of my project reports and articles. I've been working in hydrology, primarily in Louisiana, since 1982. My full professional resume is on my website, but here are a few highlights. Finally, if you are interested in claiming continuing professional development credits for attending this online presentation, print out this last slide. Just capture an image of this slide using your print screen function key and paste the image into a new document, then crop and resize it. You can then print out the document and fill out the certificate.